Good afternoon. Welcome to today's webinar. On behalf of Eide Bailey, I'd like to thank all of you for joining us to learn more about the PPP loan program as the changes that have been introduced with the Economic Aid Act. My name is Michael Holdren. I'm a senior manager in our Des Moines, Iowa office. Presenting alongside me today is Brock Timlitz. He's a manager out of our Mankato, Minnesota office. Both Brock and myself are dedicated to our financial institution services group, serving clients like yourself on the webinar today. I'd like to remind you that we do have a dedicated PPP landing webpage at eidebailey.com/PPP. We do keep this website up to date with all of the most recent insights, webinars, and everything PPP. So I would encourage you to continue to visit that website as your needs justify reaching out. For today's webinar, we're going to cover a few different areas, primarily focused on the PPP changes as introduced on the Economic Aid Act. First, we're going to cover second draw loans. Then Brock's going to cover some of the overall changes to the PPP loan program, as well as the changes to the forgiveness applications, which were released last night. And then we'll finish things up by covering a few changes to other programs, including the SBA debt relief program, changes to the EIDL program, as well as the addition of the shuttered venue operator program that came along with the Economic Aid Act. So with that, let's go ahead and get started. We'll first touch on the second draw loans. So the Economic Aid Act, the primary focus of the changes in the program are, well, at least one of the major changes is the second draw loan program. And the idea here was Congress really wanted to provide aid to smaller, harder hit businesses. And some of the changes that are reflected in the program try to address just that. So the eligible entities are largely unchanged from the original first draw PPP program. There are some new eligible entities, including 501c6 entities. That's important to some, as that would represent like chambers of commerce, housing cooperatives, as well as FCC and newspaper entities, which will be discussed a little bit more later. Additionally, specifically excluded as part of the program are publicly traded entities, businesses primarily engaged in lobbying, and covered individuals, which covers the president, vice president, heads of executive departments, members of Congress, and their spouses. And there's actually a new form that was just released last night as well that has to be prepared or completed if there is any ownership with covered individuals. So in order to be eligible to participate in the second draw loan program, a business may not employ more than 300 employees. One of the common questions we seem to be getting is, what is that measurement date? When do I have to have, or what is the date that I must meet the 300 employee threshold? The guidance is largely silent to a date, but similar to the first draw program or the original program, we believe that it would be the application date of your second draw loan. So whenever you submit your application, that would be your measurement date for your 300 employee threshold. A business also must have been in operation as of February 15th of 2020, and a business must have received a first draw PPP loan and have spent or will spend the full amount on or before the expected disbursement date on eligible expenses under the program rules. So those are three high-level tests that a business must have in order to participate in the program. Now, an additional layer onto that is businesses must also demonstrate at least a 25% reduction in gross receipts when comparing the first, second, third, or fourth quarter of 2020 to the same reference quarter in 2019. If a business was in operation for all 4 quarters, they can use an annual test. And if gross receipts on an annual basis decrease 25%, they would be assumed to have met the 25% quarter-over-quarter decline. And that can be used if there are no quarterly financial statements or filings available. It was noted in an FAQ that was issued last night that if you are using the annual measurement methodology, you do have to use annual tax returns. In addition to that additional information, gross receipts was also defined further in the FAQ released last night. Generally speaking, gross receipts is going to be all revenue in accordance with whatever accounting method the individual business uses. So that could be accrual or cash. There is specific information in the FAQ that was released going through entity by entity, and I'll touch on a little bit of that in just a couple slides. One item to remember is that PPP forgiveness and EIDL grants are excluded from gross revenue or gross receipts if received in 2020. So that would be specifically excluded. However, COVID-19 relief payments from other programs, there is no guidance on that right now. So generally, I would assume that that is taxable and then included in gross receipts for your calculation of your 2020 gross receipts portion.
Yeah, for instance, there, like with all of our farmers and all the egg program payments we received, we get a few questions on do we have to include those, and as of now, we think those are going to be included unless we get some specific notations that say otherwise.
So to dive a little bit deeper into the gross receipts documentation, there's three different, I guess, documentation or items that can be submitted to substantiate your gross receipts. Quarterly financial statements. Now, if those are unaudited, the guidance that was just released indicates that they need to be signed and dated on the first page, and all subsequent pages need to be initialed by the borrower to help attest to the accuracy or verify the information that's being provided. Additionally, the financial statement should clearly identify gross receipts or the line items that are the gross receipts pieces. Additionally, the borrower can submit quarterly or monthly bank statements showing deposits for relevant quarters. And again, they need to know which deposits would represent gross receipts for the calculation purpose. And lastly, annual IRS tax filings. And as I mentioned, those are required if you're using that annual reference period. If you have not filed a 2020 tax return, you are required to submit a completed tax return and sign and date that return, again, verifying or attesting to the information provided. In terms of calculating gross receipts from specific tax returns, the SBA released last night additional clarifications on exactly how to calculate gross receipts from the various tax returns and various forms. I'm not going to go through these line by line, but this is here for your reference. And again, the SBA and the Treasury have added a tremendous amount of information and have really gotten more detailed in the information they're providing to you as lenders and borrowers as well in terms of calculating these different items. So please use those websites as a reference.
Yep. Michael, if you want to go back to that slide just for 1 second.
Yeah.
One thing just to not, I've gotten a handful of questions on this too, is for the farmers and the Schedule Fs, that make sure not to confuse the gross receipt test with the loan application test for the loan amount. Some people have been taking line 9 plus line 1B for their loan application, and I'll touch on that a little bit later, but this is just for the gross receipts test for the 25% reduction.
That's right. So yeah, you would just use line 9, right, for your maximum loan calculation. You wouldn't get to add the cost of goods sold or for those items.
Yep, correct.
So that dovetails into the next slide, the loan calculation. So in order to apply for a second draw loan, a borrower needs to fill out a 2483 SD loan application. Similar to the first draw, they're going to take their monthly payroll cost times 2.5, using the 2019 or 2020 calendar year payroll. In the FAQ that came out last night, it was noted that if during the original PPP first draw loan, if a borrower used a rolling 12-month payroll period, so let's say they applied and received a loan April 30th. And they used April 1st through April 30th, or the rolling 12-month period up until their origination. The FAQ indicates they do need to use calendar year 2019 or 2020 payroll documentation. So in order to qualify for the second draw, the SBA is requiring that they submit updated payroll documentation, not the rolling, but instead the calendar year 2019 or 20. Additionally, the new change here is with a second draw program, NAICS code 72 entities may use a multiplier of 3.5 times monthly payroll costs. And those are your hospitality or restaurants, bars, hotels, to give them a larger loan, given the nature of how their business has been impacted. Different from the first draw program too, the maximum loan amount is now $2 million. That's down from $10 million. And as I mentioned, the SBA and the Treasury have gone to great lengths to lay out exactly how to calculate the maximum loan amounts for various entities and different entity structures. So please make sure you refer to those websites as you're completing these borrower applications. In terms of the required documentation, as I mentioned, you're going to need the annualized payroll information. You are allowed to use the same 2019 information that was provided under the original first draw loan program, so long as it meets those requirements. So they're not required to submit updated documentation if you are the lender under their first draw program. Loans over 150,000 will need to establish that 25% reduction in gross receipts, which is through tax forms, financial statements, or bank statements, as I mentioned earlier. If your loan's less than 150,000, you do not have to submit that with your loan application, but it will be required to be submitted on or before the forgiveness date. And all of these items that I've just gone over would be part of your good faith review during that application process, including the 2483 SD application. Now, one item that was released with under a procedural notice from the SBA just a couple days ago was what to do in the amount, or what's the impact of errors in calculating the maximum loan amount. So if you calculate, or your borrower calculates and receives a loan that's in excess of the maximum amount, it will not be eligible for forgiveness. If it's an unintentional error by the borrower, the SBA guarantee will remain on the portion that's unforgiven. If the lender if it's a lender error and it's a deviation from the good faith review, the SBA guarantee is nullified on the excess amount that's not forgiven. And the borrower is required to make payments on any amounts that aren't forgiven due to these excess loan amounts above the maximum allowable. So I think the big takeaway here is largely, as I mentioned, make sure you're paying attention to those specific guidance that's been put out from the SBA and Treasury. Some of that guidance wasn't available during the first draw program. Now they're saying it is, so make sure that those loan amounts are calculated correctly so you can avoid any errors in providing too much to the borrower. From the loan forgiveness standpoint, we're going to cover that a little bit more in detail, Brock will, but largely the forgiveness rules remain relatively unchanged with the exception of some additional expanded eligible expenses. The 60% payroll requirement remains in effect, as well as the FTE and salary reduction limitations and the safe harbors to eliminate those reductions. Borrowers under the second draw program and I guess under the first draw program, or any new loans under the first draw program, can elect a covered period anytime between 8 and 24 weeks after their origination. And the simplified forgiveness application was released last night, which Brock will cover. From a lender standpoint, the processing fees for the larger loan amounts, 50 to 350 and 350 and higher, remain unchanged at 5% and 3% respectively, One nice change was the loans, the smaller loans that are issued subsequent to December 27th, which is when the Economic Aid Act was signed. Those processing fees are equal to the lesser of 50% of the principal amount, or up to $2,500. So that's a nice fee income, processing fee pickup for originating those smaller loans. And bear in mind, with the additional release of the forgiveness application, that's a one-page. The administrative burden on the forgiveness side should be reduced as well. Those fees should be paid within 5 days post disbursement. And another nice win for the industry was that agent fees are only required to be paid when you as a lender have a contract with the agent. No other times can an agent come to you and say they helped or assisted a borrower and you have to pay. If that's the case, the borrower has to pay those agent fees on their own. Couple other items to go over here. Some of this is probably old news because the program's now open, but there is a new portal, no longer using eTran. There will be a time lapse between the submission of a new loan application and receiving the SBA loan number. That's an effort on the SBA's part to help work with compliance and make sure that the program rules are being followed. As a lender, you need to register at sam.gov for an identification number. That's the Systems for Award Management. That registration has to be completed within 30 days of the first disbursement of a new PPP loan. You may use your own promissory note, and the disbursement of any PPP loans has to be made in full one disbursement. There are no multiple draw notes.
Well, first, before I get started with the PPP changes, I just want to talk just briefly about a couple common questions that I get from clients, and in regards to kind of when they're entering in these new forgiveness applications for round 2 or some other items. And a lot of them that I've gotten is they say, hey, I got a borrower that's got a Schedule C and a Schedule F, but they don't have an EIN number for either. They use their social security number on both their Schedule C and F. It sounds like right now they're only going to be able to have that one application because the system is kind of pulling it off of their social security number. Unless we get some additional insight into that, I think that's the way the system works right now. And then the other one is in regards to, I saw one of the Q&As that came up was in regards to the gross receipts test that Michael talked about, the 25% reduction. It just has to be any quarter. So for the whole year, if you had an increase in your gross receipts, but any one quarter was less than 25%, you're going to be able to use that. You're going to be able to satisfy that 25% reduction as long as you can prove it in just one quarter. So I saw that in the Q&A. Michael, did you have any other common questions that you want to talk about, or?
Not at this point. I think as we go through it, I'll touch on anything that kind of comes up through your presentation.
Perfect. And then just the one other one is related to, we've heard some applications getting rejected related to DUNS, their DUNS number, and that's the Duns and Bradstreet number. And right now we think that is, the system is checking addresses and social security numbers and EIN numbers just to make sure there's not multiple applications. And so right now, I think if you ever have any loans rejected because of that same DUNS number or for certain reasons, just know at this point there is a way to appeal that. And it sounds like it's via email, but there is a way to appeal that and to be able to potentially get that application accepted. So with that, let's dive into some of the PPP changes. So just note, these changes are retroactive as assuming they were with the original CARES Act. And here's just a few additional eligible non-payroll costs. And this is really going to only affect borrowers that either laid off employees or didn't have enough payroll to meet the total forgiveness kind of with their application. And these costs will really help those applicants kind of fill up their non-payroll bucket in order to get full forgiveness. In another situation where this may just be relevant As some borrowers now there's some new rules on the employer retention credit, which I won't go into in a lot of detail, but as it stands right now, that employer retention credit, payroll is a big factor to that. And so if borrowers can kind of increase their non-payroll forgiveness costs, that may help them to get an additional employer retention credit or a better employer retention credit. So first we'll go over the covered operation expenditures. So this will include payments for any business software or cloud computing services. It will also include HR costs for processing payments or tracking payroll and other HR functions. It also covers costs for tracking and processing and costs for just different accounting functions and needs. Then property damage costs. Really what this does is this just allows additional expenses if during 2020, due to vandalism or public disturbances or any other thing, you incurred some costs that weren't covered by insurance or compensation, you're able to include those as eligible expenses. Covered supplier costs. So these are expenditures made to a supplier that are essential to the operations of the borrower. And if it was in a contract or an order and that was in effect prior to the covered period. There are some adjustments related to perishable goods that maybe you'll have to look into a little more detail if this is relevant, but that's just really more for the restaurant industry. And then last is covered worker and protection expenditures. Really what this is the sneeze guards, the drive-through facilities, outdoor parking, and different things to accommodate customer traffic and so on that the business incurred. Payroll costs also got a slight update to include group insurance benefits that can be included. And those are group life and disability insurance costs. And this will really only be a sizable amount for some of your larger borrowers. For some of your smaller borrowers, this may not be a big item for them. And really the bank just kind of has to consider how much is it going to take to kind of go through the loan increase process, which I'll touch on a little bit later, and how much benefit is for their customer. So there was additional information for the lender hold harmless. We kind of think this was always in effect, but they really added support to that by including more documentation in the bill. And essentially the lender may rely on certifications or documentation submitted by the borrower with no enforcement actions or penalties, as long as the lender acted in good faith kind of throughout the origination process and throughout the forgiveness process. And they also followed all relevant federal and state regulatory requirements. And this is just really a nice win, or just a good thing for our banks, just to get rid of some unnecessary heartburn or anxiety that they had with just items that were kind of out of their control. So next I'm going to just go a little bit into some for loan increases and what that process looks like for our banks for first draw loans. So as part of the Economic Aid Act, and there was also an SBA procedural notice that was effective that came out on January 13. And that was a really nice notice that has a lot of good information in it. But that provided for additional circumstances under which a borrower may reapply for the first draw loan or request an increase. The procedural notice also discusses the additional fee on the increased loan amount and how lenders will obtain that fee. And then first draw loan increases can only be made by the lender of record and only under the circumstances that are outlined in the notice. No other first draw loan increases are allowed. And if the SBA has remitted forgiveness repayment, there is no loan increases that will be able to allow. So essentially, if you have a customer that got forgiveness, they're not going to be able to go back and do the increase. The lender of record will submit this increase through the E-Trans system on or before March 31st, 2021. And that is subject to funds availability. And then last, they can start this process on January 25th. So just in a few days here, they'll be able to start going on those loan increases.
Hey, Brock.
Yep.
On that, have we come to a conclusion in terms of the language in there is remitted payment, right, for forgiveness. I'm asking kind of openly, do we have clarification on if the borrower has submitted for forgiveness but has not received payment, if the lender can withdraw that?
Yep. So it sounds like right now, even if the lender submitted the application to the SBA, as long as the payment hasn't been made back, the lenders will want to go right now and will want to go in there and essentially cancel that submission in order to be able to do the loan increase. It's a good question.
Yep. So I think that's important to know. If you have borrowers out there that may, because of rule changes, be allowed to have additional first draw and increase, make sure if they haven't received forgiveness to check on pulling that forgiveness application if it's been submitted.
Perfect. So the first one I'm going to talk about loan increases are for partnerships. So at the time of when we first kind of went through this first process, the applications for partnerships there was a lot of uncertainty and there wasn't a lot of clarity in the form of partnerships and how owner compensation was treated. And a lot of borrowers just used kind of the employees' costs and eligible expenses and didn't include the partner's compensation. So as it stands now, if that was the case and you haven't gotten forgiveness yet, you'll be able to kind of include that partner compensation piece in there. And then with that, the borrower just needs to make sure they submit all documentation that supports that partnership piece. And then one thing to note just with these increases also is, and this isn't going to be for a lot of borrowers, but if you had a borrower that was at, let's say 9.8 million and you found an increase of 300,000, you're only going to be able to increase them up to the 10 million, the maximum amount. I mean, it's not going to be very many borrowers, but just wanted to point that out. Seasonal employers. So as long as you have seasonal employers, as long as they meet that definition, went down too fast. As long as they meet that definition of a seasonal employer, what they can do is they can use the average total monthly payments for any 12-week period between February 15th, 2019 and February 15th, 2020. So this could be really helpful for them in increasing their loan amount for really their high times or their times when they're at their peak. And kind of the same thing with the partnerships. They just need to make sure they provide the required documentation to support their calculation. One thing with the seasonal employers is you may want to push off applying for that forgiveness. Just if their peak time that maybe doesn't fall within that 24 weeks and you kind of want to meet that 60% threshold for payroll, it may be worth kind of pushing them off a few weeks here before they apply, just to make sure they can get the full amount of their forgiveness. So one of the major changes and wins for our banks, especially our rural banks here, and were the changes for the farmers and ranchers. So there was a change in legislation that allowed farmers and ranchers to calculate their maximum amount of their loan based on gross income. And that's essentially just using that line 9 of their Schedule F that Michael touched on a little bit earlier. But that's the gross income and not net income. And just note that, and with my polling question before, that this does not include Schedule Cs. And so the reason that just goes for the Schedule Fs is that was just specifically noted in the bill, and they must have had better lobbyists going on to get that for the farmers.
And clarification there too, it's just Schedule 1040 filers. If you have a Schedule F on a partnership on a 1065, partnerships have separate rules. This would just be for the self-employed, sole prop, or independent contractors filing a Form 1040 for their tax return.
You read my mind. That was the next thing I was going to touch on, so that was perfect. So and just really with the first go around, there was maybe a lot of farmers that just weren't able to apply, and really because with corn prices the way they were in the ag economy, a lot of the farmers didn't have net income or very low net income, and so maybe they didn't apply. And now, I mean, almost most farmers have gross income of 100,000. they're going to be able to get $20,833. And then really how that helps at our bank is essentially any one of those that you guys have, you guys are going to get that loan fee of the $2,500. So it could be a nice income here in 2021 to kind of offset the margin compression. And just like Michael said, it's not for partnerships as it stands now. It's just for Schedule Fs, independent contractors, sole proprietors. And a note, farmers may use their 2019 or 2020 gross receipts as reported on their Schedule F. Yep. Here I'll just kind of run through just a quick calculation just to kind of go over an example. So if you have a sole proprietor or just a person that has a Schedule F, you just take their line 9 of their Schedule F, limited to 100,000. You take that divided by 12 times 2.5, and that's your loan amount. So for in most instances, you're going to get $20,833. Now, if you have a Schedule F that has employees, they're going to take their gross income from line 9, and that's going to be less their employee payroll costs. And the reason they're doing that is they're just not trying to double up a little bit. One thing that we don't fully know yet, and I was trying to read through some of the guidance that we got last night, is do you limit the line 9 to 100,000 and then subtract the payroll costs, or do you take the line 9, subtract your payroll costs, and limit that to 100,000? That's probably the route that I tend to think it is, but we do not know that for certain. So with like I said, in that scenario, let's say you have a loan for, let's say you have a farmer that has gross income of 130,000 and they have payroll of 50,000. You're going to take 130 minus 50, and now they're going to be at 80,000 for their eligible self-employed portion. So you're going to take that 80,000, then plus the payroll cost divided by 12 times 2.5. A little more complexity in it. And then farmers and ranchers are eligible for the second draw loans, but they must prove that 25% revenue reduction. And really, kind of like with the question that was posed on our Q&A, farmers, I mean, maybe just had a really good year with where the egg economy was at and all the egg program payments, but they may be able to, depend when they sold grain in 2019 compared to 2020, they may be able to prove that revenue reduction and be able to go for the second draw loan as well. So some other borrowers. The procedural notice noted there were some other borrowers who may be eligible for a loan increase. Those would be borrowers who return the funds because of potentially different circumstances. Maybe they return the funds because they didn't think they fit the economic necessity piece. But now if they've had a change or they've decided differently, they can come back and get that forgiveness amount now. I also want to bring to your attention that there were some guidelines in the procedural notice. If you have something coded in the system as paid in full instead of canceled, it sounds like there's going to be needed to be some adjustments to kind of switch that in order to do the loan increase. But the procedural notice has some nice guidelines on how to do that in step-by-step instructions. And then also borrowers that did not accept the full amount of the first draw PPP loans, they may be eligible to come back and get additional loan increase. Just other applicable procedures that we saw from that procedural notice. Lenders must make single additional disbursement within 10 days of processing. The SBA, the Fiscal Transfer Agency, the FTA, provides step-by-step instructions for the 1502 reporting and for making changes to loan statuses and loan amounts. And I went into that last night, and there was some nice detail on that piece. If a lender has submitted the forgiveness decision to the SBA and the SBA has not remitted payment to the lender must withdraw the forgiveness decision. So this is kind of what Michael was asking about earlier, that if there hasn't been a decision, you can withdraw that. For loan increases, and this is what I was reading through too, it sounds like processing fees will be calculated in accordance with the PPP rules in effect as of the date of the first draw loan was at the time. However, reapplications will follow the new processing fee structure. But But that procedural notice dives into that a little bit more and some details on how that fee will work. Michael touched base on this a little bit earlier, but there's just some new eligible borrowers. If they're FCC license holders and some different newspapers that have more than one location, they're eligible now. Also 501c6s, whether your town is a chamber of commerce or different thing like that, they'll be eligible as well. And then housing cooperatives under section 216B. Hopefully your borrower, if they're that, they know that they're that, and they'll come reaching out to you and let you know they want an application. Amy told me about that, and my mouse is going a little fast there. Just a few more updates on PPP. The PPP is extended through March 31st, 2021. Also, the interest rate on PPP loans is non-compounding and non-adjustable, and that's for all new first draw PPP and the second draw PPP loans. Also, with the new bill, expenses are deductible and the PPP loan proceeds are not taxable, but that is just for federal. Different states have their different rules. For instance, in Minnesota, where I work, we're waiting to maybe get some additional guidance, because as it stands now, that PPP income is taxable unless something else is changed. Forgiveness applications. So I think here, just with this being released last night, we tried to update these slides as much as possible as we could last night today, and we'll just kind of go over some of the changes, focus most of our time on the 3508S, and then dive a little bit into the 3508 Easy and the 3508. So as you can see, this is just kind of the top half of the new 3508S. It is very similar to the previous 3508S, but just with a few more. They actually said it was simplified, but they actually added a few more lines to it. But the inputs are very similar. You have the SBA loan number, the lender number, the loan amount, the loan disbursement date. Then you also have the employees at the time of loan application and the employees at the time of forgiveness. And please note that that is a head count. That's not an FTE, that's an actual head count. You also have the covered period. That may be something that your borrowers may reach out to you to get instructions on what exactly their covered period was. We also have the checkbox for if they, together with affiliates, had a loan more than $2 million. And this is just important because that is what determines an SBA audit. And then also a separate line item that was added is this amount of the loan that was spent on payroll cost. And that may be something that hopefully they're able to input that right, but that is something that they have to break out separately. And then the requested loan forgiveness amount.
And one thing to bring up, Brock, I know, and some of the information that I've read from the SBA's website is, reiterating the importance of getting the PPP loan number, the first loan number, correct when you're submitting the application for that. And this is outside of the forgiveness, but to make sure that that meets the formatting. And then on this forgiveness form, obviously it's newly released. There's not additional information from a lender perspective on what you need to do with it. But, as Brock and I were talking this morning, from that good faith review perspective, if you have the total amount of the loan and the amount spent on payroll costs, probably worth making sure that, 60% of what the borrower is reporting was spent on payroll costs does meet those eligible guidelines. Now, I would assume most will put that regardless of the fact that they don't have to put support on here. But in the event that it doesn't meet that 60% threshold, probably going to raise a red flag and maybe a reportable item for you back to the borrower.
Right. And just a quick refresher on the payroll costs, and that is the gross compensation that's paid to employees. I mean, it depends on your entity, but for the most part, it's your gross compensation and paid to your employees, subject to their limits that they have, depending if they have the 8-week or the 24-week covered period. But then you also get to add health insurance, disability insurance, vision, dental, group and life insurance, and then also employer retirement contributions. Just a quick refresher on that. So the next page is the certifications, just to kind of show you, but it's pretty straightforward. One thing to note here is that your borrowers will need to keep their payroll records for 4 years and all other records for 3 years after. So the Form 3508 does not require borrowers to show calculations used to determine their loan forgiveness amount. That is specifically stated on the 3508S. If the 3508S is being submitted for the second draw PPP loan, the borrower must submit simultaneously to the lender documentation supporting the gross receipts reduction certification. Note that if they submitted that at the time of the application, they don't need to submit that again. Eligible non-payroll costs cannot exceed 40% of the loan, like Michael just touched on. And then any eligible non-payroll costs must be either paid or incurred during the covered period. Next piece I want to talk on and just highlight a little bit, and this kind of surprisingly provides a little more complexity to the 3508S than I anticipated. So as I talked about, the 3508S is going to apply to any loans of 150,000 or less, but they did sneak something in there related to the FTE and salary and wage reduction. And what it says is essentially if you're over 50,000, if your loan amount was over 50,000, or if it was under 50,000, but together with affiliates, you're over 2 million, you still have to do your FTE calculations to prove that you didn't reduce anyone's pay rate. You kind of meet the 3508 EZ instructions. So you didn't reduce your employees or you didn't do any pay rate reductions. Because what happens, and it's kind of surprising, if you do that, they actually need to fill out their application in accordance with the 3508. So the most complex form, but they don't need to turn that in and they still turn in the 3508S. This is really adding a lot of unnecessary complexity that, to be honest, I don't think a lot of borrowers are going to be following. And hopefully that doesn't provide too much of a burden for you guys. The hoping was that if they're filling out this 3508S, you guys essentially can just kind of certify because it's less than 150. But there is a note that if they're over 50,000 and they did reduce their employees or they had some pay rate reductions, that there is a little more calculation that needs to go on behind the scenes.
So yeah, the one-page forgiveness application is 1 page, but then there's like 5 pages of instructions. Yes, they did follow the bill and or the law from Congress and the fact that the borrower only has to really fill out 1 page. But there is some additional information that does, as Brock said, add some complexity to this. And obviously there's going to be additional FAQs and more information that come out now that this has been released.
Yeah, and it's just what's really bizarre is they don't need to turn in that 3508 it says they need to do their calculations in accordance with the 3508, but they don't need to turn it in. They still just turn in the 3508S. So hopefully, like Michael said, there's some additional clarifications to kind of ease some of that process. And just one other note, you cannot use the same form to apply for both the first and the second draw loans. You can't just have one form that's kind of covering both periods. You do have to do separate applications.
I would add though that I think if the borrower can meets I think there's 3 guidelines for completing the 3508 EZ in terms of FTE reductions or not being able to get their business back because of CDC guidelines or the like. My guess is they wouldn't need to go through all of that if they could make one of those high-level checks from the 3508 EZ. They would not need to do those calculations for the 3508, just from the standpoint that they're getting relief from the FTE and salary reduction pieces. So I think the first test would be, did you have any FTE or salary reductions? Second would be, can you meet the 3508 EZ qualifications. If not, then you would probably default to the 3508 full calculation to see if you have any reduction to your forgiveness.
Yep, spot on. There was some, I did hear some notations of talking with different bankers of talking about maybe they tried to submit the second draw loan application, but they didn't have the first draw loan in the system. There was some notes on the actual 3508 form itself that said, if you have a loan in excess of 150,000, you must submit the loan forgiveness application for your first draw loan on or before or simultaneously with the loan forgiveness application for the second draw loan. So what that tells me, if you can submit your first draw loan and your second draw loan forgiveness applications at the same time, that makes it sound like you can get your second draw loan before your first draw loan is in the system. So hopefully that's maybe fixed in the system and you guys are able to work through that piece. Okay, quick, I'll just go over the 3508 easy. Just like Michael said, it's very similar to the old 3508 easy, except for now it's for 150,000 or more. And as long as you meet kind of the two tests, you did not reduce your FTEs and you did not have a salary or pay rate reduction, or you were forced closed due to compliance with governmental agencies, then you'll file that 3508 easy. The 3508 is only for if you have a loan over 150,000 and you don't meet the 3508 easy tests.
All right, and we're going to wrap things up today with some of the other program updates outside of the PPP changes that we've just discussed. And first is a new program that was introduced for grants for shuttered venue operators. The Economic Aid Act provided $15 billion in grants. And again, these are grants, these aren't forgivable loans. So there's some different qualifiers for these eligible entities, which include live venue operators, theatrical producers, live performing arts, museums, zoos, aquariums, and so on and so forth. They all will need to have demonstrated a 25% reduction in revenues. The grants are provided for those that were in operation on January 1st of 2019. You get the lesser of 45% of your 2019 gross revenue, capped at 10 million. Or if you began your operations after January 1st of 19, you take the average of your gross income for 2019 during the period that you were open or operating, and you multiply that times six, and again, you get the lesser of 10 million or that calculation. So the program is primarily focused initially on entities with less than 50 employees. And then the rollout of the program is scaled based on the severity of the revenue decline. So I think the first 14 days are for entities that show a 90% reduction in revenue, then 75% for the next 14 days. And then after 60 days, it's open to any venue that shows a 25% reduction. One thing to note on the SBA's website, it does indicate that they are not accepting applications at this point. They're still building out that program. So if you have anyone or any borrower that might meet these definitions, keep that in mind. There is a document out on the SBA's website that lays out the specific eligible expenses for the program. It's not just kind of free money. They do have to spend it on certain things. So take a look at the SBA's website if you think you have a borrower that might fall into this category. Along with the changes to the PPP program, another CARES Act program that has been extended is the debt relief program. The SBA extended the principal and interest payment relief on existing SBA loans. So these would be your traditional 7A 504 or micro loans originated through the SBA. The original CARES Act provided for 6 months of P&I payments. The Economic Aid Act extends that for an additional 3 months of principal and interest payments, and that begins with the payment that begins after February 1st. One significant change with the Economic Aid Act, however, the payments of P&I are capped at $9,000 per month. So make sure you keep that in mind. There was no cap under the CARES Act.
And one other note to that, there was just some guidance issued that banks no longer have to issue that 1099 miscellaneous for those section 1112 payments. So that just came out in a notice that you guys do not need to issue that 1099 miss for that, as previously stated.
Thanks, Brian. So in addition to those 3 months, there's an additional 5 months available of P&I payments for those that are hardest hit by the pandemic. And as I said, that's in addition to the 3 months of P&I. So 8 months of principal and interest payments for NAICS codes beginning 61, 71, 72, as long as all of those listed on the 4th bullet point there, not listing all those out specifically. If you think you might have an industry that is quote unquote hardest hit, I'd encourage you to take a look at the NAICS website and search for those NAICS codes. But those were specifically listed in the Economic Aid Act bill as NAICS codes that qualify for these 5 months of additional P&I payments. In addition, the SBA is going to make P&I payments similar to how it acted under the CARES Act for 6 months on any newly approved loans between February 1st and September 30th of this year. Again, that's going to be capped at $9,000 a month. An interesting part of what was introduced in the Economic Aid Act was that the SBA does have the ability to either lengthen or shorten the debt relief program based on the appropriations provided. I have no idea how much of the $17 billion that was provided under the initial CARES Act was spent, but this program appropriated $3.5 billion. So the question is, how many payments will that cover and how long will they last? Will the SBA need to make a change and shorten the program? That remains to be seen. The debt relief payments on SBA loans are limited to one loan that was originated after the CARES Act, and the CARES Act was signed March 27th of 2020. So keep that in mind if you're looking at introducing or originating any new SBA loans, that the payment relief is limited to one loan post CARES Act. A couple other miscellaneous things, the guarantees on the 7A loans have been increased or will be increased to 90% through October 1st. Borrower fees and lender fees are waived on the 7A and 504 loan programs. And as Brock mentioned, the Economic Aid Act specifically noted that payments received by borrowers under this program are not treated as income to the borrower. So that's a nice change there. The Economic Aid Act repeals the EIDL deduction from PPP loan forgiveness, which resulted in residual loans. So that was a nice win. The procedures have been issued, well, at least the guidance has been issued indicating that borrowers will be made whole if a PPP loan has been forgiven, and there's an EIDL amount still outstanding. The payment will be made to the lender for the principal amount, including interest. If the borrower's made payments on that residual loan, the lender will need to remit those payments back to the borrower, including interest. In terms of the EIDL program, there's also been some additional relief and guidance issued relating to those initial first grants. There are some additional eligible grant recipients. They must be in a low income community, 300 employees or less, show an economic loss of greater than 30% for an 8-week period between the dates shown below. So there are EIDL grants, and that program is now back open. So if you think that your borrower or somebody that you're working with might qualify for an EIDL grant, these are outside of obviously the lender and your institution. These would be done directly through the SBA, but an additional relief program that's available. few other changes that were provided. There is a supplemental grant that can be provided to those that applied for the $10,000 grant initially, but did not receive the full grant due to insufficient appropriations. So that's something to take into consideration. The program has been extended through the end of 2021. There is language in the bill that requires the SBA to reach out to prior applicants. So if you have a borrower that indicates that they are getting an email or a phone call, I'm not sure what, maybe a letter, what that communication will look like from the SBA, but they are required to do that, and it probably should follow up on it. It's not necessarily, you know, any type of fraud or anything from that regard. Approval of and disbursement of EIDL grants that was required to be done in 3 days under the CARES Act, that's been extended to 21 days. And last but not least, the temporary relief of TDRs, that program has been extended with the Economic Aid Act. All of the original requirements stay the same. It's just that instead of through the end of December 31st of 2020, now the extension goes through January 1st of 2022. Just would encourage you to continue to monitor your risk ratings and adjust as appropriate. You know, from a regulatory standpoint, they may issue additional guidance, but originally it was just for short term, which they considered 6-month relief of payment modifications or interest rate changes. So continue to watch for regulatory guidance on any changes there, but do your best to monitor your risk ratings and the inherent risk in the credit relationships and adjust as necessary. So, and with that, unfortunately, we don't have any time for questions. Those that have been submitted to the Q&A, we will follow up with directly. If you do have additional questions, I would encourage you to reach out to your local Eide Bailey professional, and they'll make sure and get you to the right person. We do have a team of dedicated individuals working on SBA relief programs. So please reach out and let us know what questions you might have. Appreciate everyone joining us today, and thanks for your time. Thanks, Brock, for joining me today, and